Hello and welcome. Let's quickly take you through what's played out in markets this Tuesday. And the Nifty was absolutely flat. In fact, very, very range-bound day of trade. We traded in a very tight 80-point band in the trade today. When you're looking at the high and the low, you'll likely notice, okay, maybe not 18, 90, 95 odd point band. So, but very tight nonetheless, right? What we've seen on the Nifty is some movers, and the top movers were all IT. TCS was the top gainer, 4.5% higher. Tech Mahindra was among the top 3 gainers. Eternal was the other one. Nestle, I mean, the numbers look stronger when you compare them to HUL's numbers, and therefore you saw that strength on the stock. Cipla was up 2.7% as well on the back of a marquee approval that they got, so that one also did well. There's Titan, Infosys, HCL Techs, was just some of the other buzzers in trade. Some of the top losers, HUL, BEL, Coal India, just some of the top laggards and all of them on the back of earnings. Coal India's numbers were soft. BEL is down 4.5% on the back of numbers, and HUL 7% move. So it was a tough day, but the breadth was solid, 3:2. The Nifty mid-cap and small-cap indices also in tandem. In fact, small-cap was softer. Nifty IT was obviously the key sectoral gainer. Big move on the Nifty IT. But FNOQs, Sajid here with that.
Thanks, Harsh, for that. Expiry day volatility as expected in the last 90 minutes, and we finally ended flat on the Nifty at below the 24,000 mark. There has been a lot of call writing at 24,000 that prevented the Nifty from breaching that level, and finally what we saw was the IT companies were coming to the rescue to hold the index at the current level there. There's a lot of short build-up that happened in Nifty and Nifty Bank. The index changes may not be showing you that, but if you look at the kind of rollovers that happened for the Nifty rollovers were around 60%, Nifty Bank was around 67%. And that gives you a good indication. The 30% jump in open interest for the August series gives you indication about the kind of shorts getting added to the August series for the Nifty Bank there. Look at Nifty Bank constituents. You're going to see short build-up happening across some of the private sector banks there. So we're starting off of August with a lot of shorts getting added for HDFC, ICICI, Axis, SBI, IndusInd, PNB, except for a Kotak where we saw some long build-up coming in and maybe a Federal. It was a short build-up coming in, and nearly 67% of rollover happening for the Nifty Bank there. Look at what's happening in the call and put writing for the August 4th series. A lot of position building up at 24,000 level, call writing happening there, and the distribution shows you the kind of resistance that was coming in for every time the index moved closer to 24,000 there. So a slew of resistance coming for the August 4 expiry series coming in from the call writers, and the base for the Nifty is around 23,500 at this point in time. Future gainers included Coforge, good numbers from a top line growth point of view. If you bring in organic growth also there, 10%, 10.5%. Lodha saw short covering happening at around 10% up. Kalyan Jewelers, a late mover, 8% up in today's today's trade. So among the losers, you had some unwind happening at Suzlon, where the stock was down 10%. Burn Beverages down on the back of back margins and low volume growth coming in. Godfrey Phillips is down 7% since morning. In the gainers part, you have Info Edge looking at a long build up. Torrent Pharma was seeing some shorts added, and Coforge added nearly 20% in open interest in today's trade. Godfrey in the losers, Godfrey Phillips, Force Motors, and Mazagon Dock all looking at long unwinding. So the market ended the expiry day at almost flat note. The action was in 2 indices, Nifty IT, which was up nearly 3.3%, and Nifty Bank, where we saw the index correct nearly 0.6% on the back of private sector banks.
Okay, that's the FNO picture. Cues to watch. Let's go across to Meryl. She's here with those.
Yes, bringing to you all of the important events for investors to watch on the 29th of July. In US, all eyes will be on the FOMC's rate decision, followed by Fed Chair Kevin Warsh's post-meeting conference. Following that, markets will also be tracking retail sales data for fresh clues on the strength of the US economy. And in Europe, the focus will be on the Eurozone's wage tracker, which is an important indicator for inflation as well as future rate expectations going forward. It's also a big earnings day globally with results coming in from Microsoft, Meta, Procter & Gamble, Deutsche Bank and SK Hynix. Back home as well, the earnings calendar is quite a heavy one. Watch out for numbers coming in from Adani Enterprises, Adani Ports, Asian Paints and Eicher Motors. Apart from the Nifty names as well, do watch out for Dabur, Star Health, KPIT Tech and many other major names also set to report their first quarter results. On the corporate action fund, the boards of Indostar, Surma, SGS, Sumit Industries and Punjab National Bank as well as Kesar India will consider a fundraise. And in the primary markets, do watch out for Manipal Health's IPO, which is expected to open for subscription on the markets. So yes, these were a major rundown of all the important events for you to track on the 29th of July.
All right, thank you so much for that, Meryl. Kunal Parar joining us of Choice Equity Broking. Kunal, what do you make of the market move today and IT in particular? Curious to know what the view there is now.
Well, good afternoon.
Good afternoon.
Let's talk on first about the Nifty trading at 23,985. Again, it's the second consecutive day where Nifty has given close below 24,000 level. Now, this level is, raising some concerns related to upside momentum. If Nifty is sustaining below this 24,000, then yeah, some downside momentum would be there up to the level of 23,800 to 23,600. So Nifty has to sustain about 24,000 for a clear sharp upside momentum. Now, if you talk about Nifty IT, it was like up by 3%, led by Infosys and TCS. Some positive commentary was there related to these counters, but my view is on particularly these sectors is like avoid as of now because I'm not getting that much of confidence for creating any long position in this counter. But yeah, if you are getting good profit in this counter, then it's time to book the profit because I think this counters heavily depending on some external AI and some external companies like exchanges and IBM. So if you are getting good profit in these companies in trading perspective, it's a good time to book your profit.
Kunal, how do you look at some of the private sector banks at this point in time? HDFC, ICICI, Kotak?
Well, among these banks, I think HDFC Bank is very attractive. No doubt, HDFC Bank debit flow rate 735, down by 0.50%. But yeah, I'm getting good conviction, there's good confidence on this HDFC Bank. Daily chart looks very attractive at present level. If you look at the daily chart, stock has strong support at 720 levels. Even earlier, stock took the support of the same, and afterward, even it went up to the level of 810 level. So same replicate momentum we can expect from the bank, HDFC Bank from the present level. Perfect time to get into stock with fixed stop loss of 700 level. If it about target wise, first target comes at 790, and if stock breaks this level, then further upside will be there, even up to the level of 840. So among HDFC Bank, ICICI Bank, and Kotak Bank, HDFC Bank looks very attractive at present level.
And what about your picks?
My picks, two stocks are there which looks very attractive at present level. First is Tata Care, right now trading at 355. Daily chart looks very attractive. Even we have observed some breakout on some moving averages, looks very attractive. One can get into the stock with fixed stop loss of 348. If it about target wise, first target comes at 361 and second comes at 369. Second stock is Mankind Pharma, looks very attractive on daily chart as well as on weekly chart, trading at 2670. We can keep SL at 2575. If it about target wise, first target comes at 2650. And if stock breaks this level, then further northward march would be there even up to the level of 2705.
Okay, thank you so much, Kunal, for coming in, speaking to us and giving us that perspective. We'll let you go. All right, moving on, what we'll do is slip into a very short break, take a bit of a breather. But on the other side, the theme of the day, IT, what's really keeping the sell-side analysts really positive with regard to IT and, some nuances around it. We'll discuss some of those on the other side. It's going to be a very interesting conversation. Stay with us. Welcome back, and we're joined by Sishovan Nayak. He's research analyst Anand Rathi, Institutional Equities, to talk about his latest report. Sishovan, in your latest report, you've written we're at an interesting inflection point for IT services. Tell us a little bit, what's changed on ground?
So, Harsh, the way I see it is effectively, if you look at what's happened over the last week, let's say, right? Obviously, the Q1 FY27 results for the IT companies, they were weaker they have been weak, and that was on expected lines because of the AI-related deflation, the Middle East impact, so on and so forth. But I think most of them have basically delivered results in line with the consensus, right? I believe that had already been baked in as we discussed the last time around also. That's one. And secondly, if you see what's happening in the last 1 or 2 weeks, effectively, Kimi K3 was launched, which was basically an open-weighted model with almost 2.8 trillion parameters, functioning as good as possibly most of the larger frontier models, if not better than them. And that was one development. Secondly, I think in the last week, Google or Alphabet, they announced their results, right? For the first time, their capex was negative $6 billion. And they've also increased their capex guidance from almost 185 billion at the midpoint to now it is 200 billion at the midpoint.
But Sishovan, the open source models, they come with its set of risks because China is a factor there. What do you make of that?
Yeah, so that is one bit which is a fair concern, Harsh. But there are two ways of looking at it, right? Open source models can also be hosted within the enterprise. While I think guys like Alex Karp from Palantir, even Satya Nadella, they had basically mentioned that if you have closed frontier models, then enterprises risk the loss of, firstly, they have to pay money for that, and at the same time, they also have to uh, 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 expose whatever their workflows are to the frontier company. But with an open weighted model, what you can basically do is you can host your workflows effectively on prem, right? So you have more control over your entire workflows rather than a closed API having control over your workflows. That is one bit to it. Second, I think that's a fair concern. The Chinese concerns are there. But then if you look at what's happening in the US, right? Uh, uh, NVIDIA has its own open source model that is called as Nematron. And then you have very recently, I think Mira Murati's company, they had come up with Inkling, which was again benefiting from Kimi Kimi open-weighted model because they had also done distillation via Kimi. So these are two alternatives which are there. But having said that, I think the way forward will be open-weighted models, and it is quite contrasting because the authoritarian government has got the most open-weighted models, while the most democratic government has got most of the models which are closed-weighted models. So it's quite an anomaly there, but that's how it is.
Hi, Sishovan, Sajid here. So, what is the timeline for realization, and how quickly do you expect enterprises to adopt this new AI paradigm, and when will this impact be visible?
So, if you look at, there are two alternatives to it, right? Harsh, the way I would look at it is, let's say we continue with the closed models. So if that happens, then effectively they will have to reduce their pricing significantly because the open weighted models, their pricing is almost 1/10 of, or possibly 5% of the pricing of most of the closed or the frontier models, as we call it, right? So either the frontier models have to reduce their pricing, but that will come at the cost of uh, 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 the cash burn increasing for them. That is one. The other thing is, if you look at what is happening in the US enterprises, and this is quite an interesting data point, that possibly end of 25, the total number of tokens which were consumed, and this is the data from Open Router for US enterprises, almost 30 to 35% of the total tokens consumed were open weighted tokens. Now, it's almost 60% of the total tokens consumed is open-weighted models as such, which basically goes on to show that they are being adopted quite aggressively or quite democratically within the US itself. The way enterprises are looking at it is any work that is very repetitive by nature has got lower complexity, which almost 80 to 90% of the work is, right? So for that, you use your open weighted models. And for the work which is basically very complex, requires reasoning and orchestration, you basically go to the closed models. And for that, you have your frontier models. Possibly what we'll see is most of these models will end up getting hosted within the client locations, or on-prem as we call it, right? Possibly that would be the way to go, and that would result in incremental opportunities for Indian IT, because if you host it on your premises, you would need to implement that. You would need to have these multiple workflows which needed to be done for the implementation. All of that are basically billable work hours for IT services companies. So that is basically a positive if open weighted models are the way ahead, right?
Interesting. You mentioned an inflection point for industry. How are SAP and service now positioned to changing this landscape?
So there are two metrics which we generally look at. One is your subscription revenue growth. The other is effectively your remaining performance obligations, or the TCVs in a way, as we call it. The third bit is basically your current cloud backlog, which gives you what is the growth for that. Now, that generally has been at least 200 bips higher than consensus. Earlier, the perception was if there is any miss as far as these revenues or the cloud backlog growth is concerned, then effectively these stocks correct a lot, because the assumption is that their work is being cannibalized by the frontier model companies. But now they are actually delivering growth better than what is expected, to the extent of almost 200 bips as far as SAP is concerned. Their current cloud backlog, I think, is the growth has been 26% versus a consensus of 24%, right? And similarly, ServiceNow also, I think, their remaining performance obligations to the extent of 21.5 versus 19.5%, which is the consensus. So they have basically delivered growth much better than expectations, which gives comfort that, software or enterprise software, which are the systems of record, are here to stay. Having said that, there is another data point also which will end up benefiting these enterprise software companies, which is also our thesis that they are the ones which should re-rate first, which we believe will happen this year. And then possibly the services companies will end up benefiting, because they are the implementation partners for the enterprise software companies. Now, if your open source models get adopted, right, your token costs obviously reduce. And for them, that for the enterprise software companies, your token cost is effectively your cost, and then you sell those and you get your workflows done leveraging on these tokens. So if your cost reduces, then obviously your margin is going to increase. There'll be some benefits which you will pass on to the customers, but then you will end up making more money, because at the end of the day, these are initially passed through, and then you make margins on them. So that is one thing that will end up benefiting if the cost of tokens reduce, right? Because your enterprise adoption is also going to increase, which is that democratization of enterprise AI, as we call it, right?
And Shishwan, very interesting. What happens to Indian IT services in this context? Because the growth is roughly 3%, constant currency 5% INR broadly for large cap IT. Why aren't they speaking about this kind of opportunity? I mean, in a big fashion, and trying to up their guidance.
That point, I guess, possibly what will end up in the large caps would be close to 3 to 3.5%, right? And out of that, also possibly there'll be some 50 bips to 100 bips that will come from acquisitions. So we'll possibly end up in that range of 350 to 400 bips growth for the large caps. That is one. And the growth, I believe, will be higher in FY28, because what I also end up thinking is that despite your token costs reducing, right, your actual enterprise token usage or the volumes are more than offsetting the reduction in the price in the token costs which are there, or per token costs which are there. And that is a result, or that is the reason why you're seeing Uber, Palo Alto, all these folks coming up and saying that the token costs per token has to reduce significantly for them to make money, or for the return on investment to be justified. If that is the case, I guess come October, November, when most of the enterprise budgets are to be decided, possibly we'll see a phase wherein the labor arbitrage basically may come back into play, because they will think, okay, why should I just have completely denominated everything in tokens? Let me have a mix of humans and tokens, right? So that may just, trigger a higher growth rate potential for IT services, which will possibly drive growth back for services. That's again my hypothesis, but happy to stand corrected on that.
So how should investors position themselves in this theme? Would you prefer large cap IT, mid cap, or pure play AI companies such as Fractal?
The execution focused scaled players are the ones which will end up benefiting, and our thesis has not changed beyond that, because the way I would look at it is someone like a TechM, a LTIM, and an Infi in the large caps, a Coforge, although we don't cover it, Persistent, and an Emphasis in the mid caps. Why specifically? Because see, what's also going to happen is, if you look at most of the guys who are doing the capex, the hyperscalers as we call it, right? A lot of IT companies have them as their end customers. Now, when these guys want to cut, I mean, they will obviously start pushing the vendors, and when that happens, they will do a lot of vendor consolidation. In the process of vendor consolidation, the ones which are going to benefit are the scaled execution focused guys, right? So possibly a large number of these mid caps may end up getting impacted, because whichever have got a higher technology exposure are the ones which may lose out the deals to these larger folks which I mentioned. So in my view, the scaled execution focused plays which have got, are actually investing in AI, have got good AI platforms, are aggressive from a growth standpoint, execution focused leadership, they are the ones which should end up benefiting. And these are the names which come to my mind at this point of time, which are also our top picks as such. And Coforge, obviously, we don't cover it, but yeah, that's also a superb execution focused play.
All right. Thank you so much, Shashavan, for coming in and speaking to us, giving us that perspective. We'll let you go. Well, it's very interesting, right? How all of this is playing out. And it's going to be even more interesting as to how the street is going to view this. Or rather, the companies are going to come out with their commentary on some of these factors playing out. Of course, Q1, nothing of this sort really been spoken about. It's a unique view.
We've been talking about it, right? Means
yes.
There are two managements who've been talking about token cost. Yes. Now the question is that token cost is going to come into an SG&A. So when it comes into the SG&A, what we spoke about is a labor token arbitrage comes into play. So it's going to be an hybrid model which may come in, because you may not want to spend so much on token, because it's somewhere around 70 cents per token. That's a rate which is going on. So that's the kind of cost which companies will have to factor in. So AI is not coming in cheap for anyone in that sense.
Okay. All right. With that completely timed out on this edition of Market Edge. Thank you so much, viewers, for tuning in. More action on the other side. Stay tuned to ET Now.